Welcome to the MUFG Global Markets Podcast. I'm John Cook, and today I'm joined by George Goncalves, MUFG's head of U.S. macro strategy, and Agron Nicaj, MUFG's U.S. desk economist, for a special podcast on our 2026 macro to market outlook. It's Wednesday, January 7th, 2026. George, welcome back to the podcast, and Agron, welcome. I believe it's your first time on with us. Long overdue. I'm excited to do it.
It's great to be on. I look forward to the conversation.
Yeah, and John, it's been a while for us as well, and it's great to finally get Agron on, as you said. And in today's podcast, we're going to discuss our house views.
Yeah, I think it's been I think we're overdue for one, and we've been talking about having Agron join for forever. So yeah, definitely excited. To get into today's episode, what I'd like, as I kind of alluded to, you and your team recently published your 2026 macro to markets outlook entitled "Smooth Sailing Ahead," and I will emphasize that ends with a question mark. So I think the idea is to kind of, go over that piece and more broadly review your thoughts heading into 26 and your outlook. George, given that we've got a lot of ground to cover, I'd suggest that we break the episode into parts. You can kind of set the stage with the base case view. Then we can turn it over to Agron to do the underlying, kind of rationale for that view from an economic and other perspective. And then we can maybe bring it back to you to talk about what are the implications for the Fed? What are the implications of the markets? How does that sound?
Sounds great.
Okay, cool. So right into it. George, as discussed, big picture. Judging by the tone and analysis in your team's report, you appear a bit, I guess I'll call it cautious on the macro backdrop. And, obviously it's hard to get a sense of what everyone's thinking, going into this, but I certainly heard others, who are projecting, what I'd characterize as a more optimistic macro outlook, including some are super bullish. So I guess, back to the question, help us understand, your kind of caution heading into financial markets in 2026.
No, absolutely. So I think maybe kind of setting the stage, one, kind of paraphrase a saying in the sense that be cautious when others are greedy and be greedy when others are cautious. In general, consensus is pretty optimistic for another sort of kind of banner year. And it's understandable why, which we'll get into it in a moment with Agron's or with our view, as well as some of the risks to our view. But I do think starting points matter, especially for market valuations, financial conditions more broadly. But that said, it is hard to be too bearish in the first half of the year. So we kind of characterize very big picture. This 2026 might end up optically seeming like it's smooth sailing until it's not, and it might end up being a tale of two halves. Where the beginning of the year we have some of the benefits of the one big beautiful bill tax impulse. The fiscal impulse in general coming from the pent-up demand from the government reopening in the fourth quarter. We have the World Cup kind of setting up in Q2 into the early part of summer. 4th of July, our 250th anniversary in the U.S. I'm sure there's going to be some extra spending on that too. So it's
no doubt.
It's hard to get too bearish in the beginning of the year. But we do think that kind of sets up for like a head fake of what the true underlying strength is in the economy. And as you'll hear from Agron in a moment, a lot of last year, going back to this whole starting points concept, last year, the wealth effect, the AI spending drove a lot of both the markets and the economy. But, for us, we don't think that's enough. We think we need to kind of see more of a broadening out. And so we have our doubts that it's going to be just, only smooth sailing from here.
Yeah, I mean, I think that's pretty fair. Using a broad brush, risk assets on various measures are kind of at all-time or near all-time highs. So as you point out, starting points matter. So Agron, let's get into some of the specific examples that underlie the outlook. For growth. Is it sustainable? I'd also like to touch on the labor market. That's been a conundrum for many recently in this sort of like low hire, low fire environment. Will that continue? And then also inflation. That's it's been relatively benign. What's your view on that going forward?
Yeah, thanks, John. I'd say the big question really is AI. As of right now, it's difficult to say with any certainty whether it's providing this big productivity boom that everyone's expecting, but nevertheless, it has been boosting the real economy. We saw it in fixed investment growth in the first half of 2025. We see it in non-residential construction employment, especially for data centers. and we see it in the S&P. And this has been really boosting household wealth, especially for those wealthy Americans that at the end of the day really drive consumer spending in the United States. This is the big reason why we continue to see strong aggregate consumer spending. We saw it in Q3, Q2, and Q1 of 2025. And this is despite real incomes really not growing. That's kind of this element of this low hire environment where we're not really adding jobs, but people are still spending money.
Yeah, and this has been something that you and the team have been talking about for a while. It's like, the and why the stock market is so important to like the real economy.
Absolutely. It goes back to the whole K-shaped economy where you have those that are trending upward, really driving growth, and then you have the lower income households that are falling behind in a sense. The big question is, in 2026, can this continue? We already saw that AI-related fixed investment did slow pretty substantially in Q3, but for growth to broaden out to other industries and to have a robust economic growth, we need to see non-AI sectors starting to grow. The goods industry in particular has been really struggling, especially if we look at the auto sector. That is, since the passing of the One Big Beautiful Bill, it's no longer really being supported by a lot of the EV-related subsidies. So this industry and overall goods are probably going to continue to struggle in 2026. Now, going back to your question about the labor market, what does this all mean? AI, it can boost the economy in dollar terms, but it's really a small subset of overall employment. So as long as growth in the non-AI sectors are weak, we can continue to expect weak labor demand for the vast majority of the U.S. economy. Now, with respect to the unemployment rate, as it stands, it's at 4.6%, and a consensus forecasts are huddled around 4.5% for the duration of 2026. If you were to chart this, you would see just a line moving sideways, which historically is very uncommon. The unemployment rate either trends upward or trends downward. So this would be a strange anomaly if these consensus forecasts actually materialized in that way. We see a more distinct and a stronger probability of the unemployment rate trending upward toward 5%, for the reason that we don't see labor demand strongly picking up in the non-AI industries that comprise the vast majority of the labor market. With respect to inflation, it's been slowly trending down despite core goods prices remaining elevated from tariffs. The tariff effect has potentially peaked. It remains to be seen. But if it has peaked, that's going to support accelerated disinflation. But even if it hasn't, the core services components, which really hold the biggest weight in the CPI and PCE basket, those are the ones that are cooling a little bit more rapidly, especially in housing. And if we continue to see weak housing demand, it's going to continue applying downward pressure on housing inflation. So from that perspective, inflation might be a little bit stickier in that sense, but we do see disinflation continuing throughout 2026, potentially at a more accelerated rate if we have passed peak effect from tariffs.
Yeah, I mean, so that sounds all pretty reasonable. I mean, maybe not. We kind of started this thing out talking about how you guys are a bit cautious on the outlook, but it doesn't seem unreasonable. AI has been driving the economy. I think we all know that. Will economic growth broaden out? That's a question. The low fire environment persists, but that causes the unemployment rate to tick up in your view. And it kind of sounds like the inflation, the disinflation process, continues with tariffs, the tariff effect lagging, but things like owner's equivalent rent and other measures of housing ending up taking inflation lower. Is that a good summary, Agron?
Yeah, exactly. I think you really hit the nail on the head with most of that, and for that reason, we're a little bit more cautious than perhaps consensus surrounding 2026, especially for the later half.
Yep. Yeah. Seems fair. Okay. So George, we've set the big picture. Agron's given some of the fundamental underpinnings. What does this mean for the Fed? What does this mean for rate? And other financial markets?
Sure. And that kind of cautious tone does kind of play into our view that the Fed should lean into it. The question is, in terms of more cuts and more easing, the question is, it's hard to really get our arms around like what is the reaction function when we're in the midst of also changing leadership at the Fed. And so 2026 is going to be interesting as a Fed watcher, trying to understand the implications of the macro, which if we're right on our outlook does argue for more easing. But at the same time, though, you have some concerns with current Fed governors and definitely Fed presidents about they've eased a lot already, and they're still been above their inflation target for almost now 5 years running. I think it's going on close to 60 months or something like that. It's one of the longest on record. You can see that in our outlook report as well. But we think this is going to be slightly different from last year. But last year we were basically on average expecting the Fed to cut 3 or 4 more times, and they cut 3 times. We have basically the same sort of a call for this year that they're going to get rates down towards neutral, maybe slightly under neutral, but for different reasons. One, if we're right on the unemployment rate and it keeps heading higher, that's going to be enough justification for the Fed to cut. But then we have this kind of awkwardness around when there's this shift in leadership, and will the next Fed chair really pound the table for even larger cuts and get us even under 3% on Fed funds. And so that's the part that's kind of the the path and the sequence and timing of cuts for us remain unclear. But we think the total will end up being almost like last year's 3 cuts. So that's our kind of base case.
You've got 3 cuts penciled in for 2026?
We have 3 to 4. Yeah,
3 to 4. Okay.
Yeah, 4 being depending on what kind of Fed chair, who we get as a Fed chair, and we can discuss that later in future episodes. But more kind of hinged on like how dovish could the Fed pivot again and why? Are they pivoting for the right reasons or not? And so that's our base case in terms of rates, which is a little bit more than what's priced in. The market's around 2.5 cuts at current timing.
And the dots are only 1, if I'm not mistaken.
Yeah, and the dots are only 1. But as we've seen, in times past, the Fed has like 1 or 2 cuts, and they end up delivering 3 and 4. Like in both 2024 and 2025, they delivered more cuts than they got to the lowest level during those SEP forecasts. They still went beyond their lowest bar. So
agreed.
I think they're going to end up cutting more than that just 1 cut. But beyond that, the tricky part, as we all know, looking at the rates markets are forward-looking and have jumped in and priced in a lot of this. And so given the 2 halves of the year, if the first half looks a little bit better, and you get all this supply coming both from investment grade issuance, from the Treasury market, and slightly better growth data in the first half, then that could create an environment where you get one last sell-off in rates, which we would view as a buying opportunity. The same thing is true for mortgages. Mortgages have probably tightened a little bit too far, but if they were to come under some pressure, if rates were to back up here, we think mortgages are better. So our slogan is buy rates on dips and sell credit on rips, and I think that's going to be the case. 2-10 curve is going to go over 100 at some point this year, but later once the Fed really starts to cut. I think we probably touched on most of the points. The last part I think it's important to emphasize, and you touched on it a little bit, John, is that valuations are never a timing metric, but they definitely give you warning signals. And risk markets are pretty stretched. It's been driving, again, the economy more so than the economy driving the markets. And so any sort of wobbles or a more significant drawdown in tightening of financial conditions can both throw out our script, but everyone else's, which are much more optimistic than we are. So if we get a more meaningful kind of correction that's lasting, again, not knowing what the catalyst may be other than things are stretched, I think that could change the narrative very quickly. So the caution also stems from the fact that stock markets, other financial assets are very highly valued, spreads are very tight, that something takes it off will impact the economy and markets, and that would then create even lower rate environments.
Yeah, I mean, it sounds like the sort of environment where, especially with implied vol being pretty low, where you're probably supposed to be long some tail risk.
Absolutely.
Or protection against tail risk, I guess I should say. So we talked about Fed cuts, we talked about the move in the curve, we talked about buying mortgages on dips and selling credit on rips, which I love. What about the out the curve? Like what are your rates, projections here? You've got a couple good charts that I have the benefit of looking at here with kind of your base case range and your bull and your bear scenarios. But like let's say 10-year rate as an example, where are we now and where do you expect it to go? Yeah.
If we're going to focus clearly just on the benchmark 10-year, we think our base case is 375 to 4 3/8. Let's call it 4.4 to make things easy. So 3.7, 4.4 is kind of should be the range. So once you get, if we were to see again animal spirits, better information, better data in the first half, and rates were to go above 4.25, that's definitely a buy zone on the 10-year. And we could see us towards the end of the year start to make a move under 4%.
Got it. So it kind of sounds like the 10-year stays pretty range bound, and what drives the curve steeper is the Fed cutting 3 to 4 times.
Exactly.
Okay, great. George, Agron, great stuff. For our listeners, if you have not seen George and the team's macro to markets outlook, again entitled "Smooth Sailing Ahead?" Definitely check it out. And if you are still not receiving the team's strategy reports, do check out the MUFG research portal at www.mufgresearch.com, where you can find all of your favorite MUFG research, as well as to have it conveniently delivered directly to your inbox. So, George, great stuff as always. Agron, great job first time on. I definitely think we should do this again.
100%. Thanks for hosting, John.
Thank you, John. It was a pleasure.
Yeah, mine as well. And to our listeners, thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.